Good morning from the morning reading. Good Friday employment reports that led to Monday gaps lower have been rare, but have been an overreaction each time. Traders in the RightX family of mutual funds have jumped into the financial services funds, pushing assets close to the highest in a decade, which has led to some trouble for the sector. In the large cap S&P 500 and S&P 100 indexes, option traders are holding more than 200 put options for every 100 call options, the highest in history. Other extremes in the ratios have led to a struggling stock market. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:40 a.m. Central Time, and I'm recording this in preparation for the market day of April the 6th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see just where we are. We have, in effect, an extended overnight session in that we had trading that occurred Thursday night into Friday morning. The futures markets closed at that point. We had, of course, the big monthly unemployment report, which had the futures markets trading for a little while into Friday morning after that report was released. Markets all closed. Cash markets never open. Then Sunday night, of course, the futures markets reopened, and we had an extension of this, in quote, overnight session. So a little bit of an odd circumstance with the trade holiday on Friday, plus the unemployment report, mixing everything together for a pretty unusual open. Now, with this extended overnight session in effect, we take a look now at where are we. You look across all four of the broad market indexes, and we're down pretty significantly as of the time of this cut earlier this morning. You see the Russell was down almost 1%, and the other indices are down about 2/3 to as much as 3/4%. You have crude oil up 2.83%. You have the bonds essentially scratch. You have the euro also about scratch, and then gold well up as of last night into this morning, up about 1.53%. So a couple really big movers in our commodity space with gold and crude oil, and a pretty significant weakness coming into the open for our broad market indices. And overseas action, China was up about 1%, Hong Kong up about 0.75%, Japan down marginally, Germany down about 0.25%, and the United Kingdom up about 0.33%. In terms of macroeconomic reports coming in for today, we have an FOMC member speaking, probably already speaking at this time, and then we have, let's see here, in terms of significant reports, doesn't look like much else going on for U.S. reports. In terms of tomorrow, again, not much to speak of, so pretty light coming into today and tomorrow for macroeconomic reports on the U.S. side. In terms of volatility metrics, obviously this is going to be reflected as of the Thursday close, and a lot happened since that, but we will note that we continue to have relatively low historical IVs, but relatively high counts of standard deviation moves. So really no new changes on that front from when we last spoke on Thursday morning. Obviously, we expect there to be a significant hopping kind of action coming into today's open as a result of the Friday unemployment report. The daily report, let's get into that. Futures report, nothing really on our grid for this week in the futures markets that we trade. In terms of our trends, we continue to have the same trends. We're still despite the weakness, we're still in a phase 3, looking for higher highs and higher lows. Now, that could very well be challenged today If we break down and then break out of these ranges, it is possible that you could break down as far as all the way back to the October swing lows if things were to really get going. So that is certainly in the picture, while at the same time we've not actually established anything of the sort yet. Now, we do have elevated risk levels, and we'll get into that in just a second, but we're still in the long, big picture. You still have to understand that we're still in a strong bull. If you look at moving averages, key moving averages, if you look at the primary trend, it's still a strong bull. Intermediate doesn't look so pretty, and short term certainly looks quite ugly. And indeed, our investor posture, IBD status, is uptrend under pressure. GMI index of 3 out of 6 was still a buy signal. Active trader market posture went bullish on Thursday, though I would put a huge asterisk by that, because obviously new information has come into the marketplace since Thursday, and we could see that stance change today unless we get a very bullish recovery candle going on. Position sizing opinions. One opinion calls for exposure up to 50%. The other, based on volatility, says it can be up to 100%. We see from the market posture, we have 3 of the 4 indices did turn up into a bullish intermediate stance, and would be saying that it's okay to put on new short-term and intermediate-term trades, but obviously new information has come in since this Thursday close, so huge asterisk by all this. I wanted to report it as it was calculated, and yet at the same time you've got to put into context what's happened since Thursday's close. We do still continue to have a threshold level 2, which is a red light on our hedge warning status. And so this is pretty serious, and indeed we have a number of measures that cause this. We have a daily squeeze on the VIX, and generally we look for that squeeze to eventually fire to the long side, which would mean that the market should go down. So that certainly is not helpful. We have this distribution day count in the S&P and NASDAQ that is a very high 9. We have also the need for this higher high, which certainly we have not gotten anytime recently. New highs, new lows. Thursday looked quite healthy, but obviously again new information coming in on Friday morning that has not been reflected in the broad market, cash market yet. Crash warning has fired on the S&P a week ago, and certainly that is in the warning indicators. And importantly, our risk aversion indicators, all 5 of them are still risk off, and this is even with the Thursday close. It doesn't even take into account what's happened with the action on Friday. Couple updates here in the next section here. Option income strategies. While the VIX is still inside the acceptable window, we have had, of course, this significant number of standard deviation moves occurring in the last 2 weeks to increase risk. So at the very least, if you're going to put on option income strategies, consider reduced position size, consider the need to account for volatility likely increasing at some point, especially if you have a strategy which requires 30, 45, or even more days to expiration to fulfill. In terms of covered call strategies, also a new opinion here. We've now gone with a neutral stance and calling for a ratio of 2-to-1 distribution between in the money and out of the money strikes. So, for example, if you were to put on an Apple covered call, you'd want to go with 2 in the money strikes and then 1 out of the money. In other words, very, very, very kind of conservative stance to putting on that cover call. We frankly would think it best to not initiate a new position and to just simply wait for a better trading environment for that strategy. But something to keep in mind. So this is tamped down in its distribution from being even number of strikes in the money and out of the money to a 2-to-1. Put selling also has gone to a neutral stance. It is acceptable to sell puts against the core portfolio basket of stocks that you're willing to own, but given all the other hedge factors and risk factors, caution would be exercised and establishing new positions until we see some sort of bottoming pattern form, and to be able to initiate those new positions from that kind of a pattern. The risk levels are pretty high right now, and if you were to put on especially naked puts, you could very well find that your situation is going to require a lot more time and rolling out an effort to be able to work given the current risk factors. In terms of the current relative rotation graph, you see not a lot of health here. I mean, obviously the biotech and semiconductor and home construction and retail remain as the strongest sectors on this particular graph, but you notice, they're not other than this ITB, which is home construction. The others are, while they're in the upper quadrant where you want them, this upper right quadrant, which is what's being shown here. Here's your center point. You don't exactly have these things firing off into the upper corner. In fact, XBI is really been on a roller coaster of late. XSD, the semiconductors, not going anywhere, terribly positive. FDN's also lost its slope. So retail and ITB probably the two that are in the short term making the most progress and showing the most relative strength. But at the same time, it's a very difficult market, and this kind of a market will drag everything down. In terms of point and figure, notice that we've had a change on the dollar. So it's been a very long time since the dollar has had a bearish outlook and pattern. So that could have ramifications across a whole host of different other sectors and industry groups and the market in general. So kind of keep that in mind. It could also play into, if you're a currency trader, that we've now had a new posture on the dollar could run across many of your favorite pairs. Sector market postures, again, this does not reflect Friday's activity, so we'll probably just kind of move on here. Obviously Thursday was up. Things look like pretty good Thursday, but that is not going to be your situation that you're going to have as you open up this morning. In the most healthy sectors, again, and the most healthy industry groups: retail, internet, healthcare, railroads, transportation, biotech. As things right themselves, those will be the areas in which you will want to focus your attention as you develop your watch list, and perhaps you start selling some puts against some of your favored positions. You start putting on some bull put spreads. You start perhaps scaling into some of your stock positions that you've been wanting to enter. Obviously from a value proposition, there's some opportunities when you get this kind of weakness, and you can look for those opportunities to start moving in. It's just we don't see any signs yet that a bottom has formed on this pattern. So again, you should be quite careful with your entries at this point. So that should take care of our action today for this video. As always, greatly appreciate you liking us on YouTube. And if you have any questions or other information that you need, certainly the website or the email support at falconglobaltraders.com. Disclaimers, as always, just hit the pause button, and you'll have more time to read this at your own leisure. Thank you once, twice, and every day at Falcon Global for all of the Falcon Global trader community. Good trading, and we'll see you back in the same place tomorrow.